Thank you so very much for joining this CSAE Development Economics webinar. Before I introduce our speaker today, let me just explain the rules. Illenin Kondo is going to talk for 45 minutes. During this time, you'll have an opportunity to ask any clarifying questions you might have. If you're an attendee, can you please use the Q&A box to type in your question, and we'll read those out loud to the speaker at a convenient time. If you're a panelist, then can you please use raise your hand button? At the end, we're going to have about 13 minutes for questions, and during this time, you can use your raise the hand button, and when we choose you, we'll unmute you so you can ask your question to Illenin Kondo directly. Today, I'm very excited to welcome Kondo from the Federal Reserve Bank of Minneapolis. He's going to be presenting a borrowing in the shadow of China. So thank you so very much, Kondo. We are very excited for your presentation. The floor is yours.
Awesome. Thank you so much for the invitation and for the introduction, Margarita. I'm very happy to visit virtually. And today I'll be presenting one of my sort of pandemic projects, very early stage. So comments, welcome. Titled Borrowing in the Shadow of China. It's joint work with Astic Secretarian, who is a student at the University of Notre Dame, and Cesar Sosa Padilla, who is my former colleague at the University of Notre Dame as well. These are my views and not the views of the Federal Reserve of the Bank of Minneapolis or the Federal Reserve System. As I said, this is relatively early work, so feel free to ask questions far away, both during the talk and obviously later. All right. So the broad motivation for this paper is quite obvious. China has become a major lender to developing nations. In the table below, you see from every 5 years from 2000 to 2015, as I go from, I'm showing you just first how many countries are reported to be borrowing from China. And you see the number jumping from 15 in 2000, in the year 2000 to more than 100 in year 2015. The amounts are also relatively significant. The median level of Chinese debt to GDP reported as of 2015 is 5%. The mean is obviously higher. And if you compare that to the other debt, external debt these countries are holding, it's also non-trivial amount of debt. As of 2015, compared to the external debt these countries have to bondholders, the Chinese debt is represent about 69% of that. So it's quite sizable. And obviously, because many of these developing nations have bilateral debt with Paris Club nations and others, relative to the overall external debt, it's not as large. It still represents about a quarter of the overall external debt. So this is sort of the broad motivation and the reason why one would be interested to think about sort of what the advent of China has meant for the macroeconomic position of this country. So obviously, I know this is the CSAE. You guys are used to more sort of RCT style or applied work. This is going to be a mix of a little bit of sort of empirical work and modeling work. But I think this is these numbers tell us that this is an important topic to discuss when it comes to developing nations and the many African countries that are borrowing from China. No, and beyond the size of the debt that developing nations owe to China, one of the issues around it has also just been the relatively opaque nature of those debt contracts. We don't know a lot about it. And because we don't know a lot about it, has also been a concern for other lenders, both institutional lenders such as the World Bank, the Paris Club nations, but also private lenders on the international debt market. Carmen Reinhardt, who basically wrote the book with Horn and Trebesh on trying to sort of do investigative work to pin down the level of debt that developing nations owe to China. It has a quote here saying, for investors, the limited information they have hinders them in making investment decisions about bonds issued by those countries if they don't know how much is actually owed to China already. And so today, what I'm going to show you is this project is a research project where we try to study both in empirically, but also through the lens of a sovereign default model, the impact of official borrowing from China on both quantities, such meaning debt dynamics, but also prices that is spread on marketable sovereign debt. So in the back of our head, sort of there's China, and we have this bilateral relationship with China, but we still have international capital market that have to price the debt that those countries owe to on international capital markets. And we're interested both empirically and in the model about the interaction between those two. So specifically what we do is that our project has two ends. We have an empirical side and a more model in front. On the empirics, what we first do is that we just combine data on Chinese funding and restructuring events from Horn, Reinhardt, and Trebesch, with bond level data that allows us to basically have a sense of sovereign debt issuance as well as prices that different countries are facing over time. In particular, we're going to, so just to give you a heads up in terms of what we're going to use that data for, I'm going to document three styles of facts. So the first fact is going to be related to the amount of the debt. And I'm going to basically we're going to use the data to see how, to suggest that the external borrowing from private lenders tends to be lower, that there seems to be a deleveraging channel associated with Chinese lending events. So we also tend to document that sovereign bond prices tend to be lower really following Chinese lending events. But on the flip side of that, because Chinese funding is not always a one-way street, there are some times where things don't go well and they have to restructure. And what we document is that sovereign yields are very volatile. They increase very sharply after that restructuring event. I'm going to get in the details of both the data and the specifics, but that's going to be the upshot of what we do in the empirics.
Apologies. One question. Just coming back to this quote, this was Reinhardt, right, on the previous slide?
Yep.
What is this limited information issue here? Is it that only the Chinese stock of Chinese debt is unknown, or do these countries not report all sources of debt, or how does it look like?
It's actually both. The amounts are unknown, the terms are unknown. In fact, just for the sake of time, I'm going to refer to it, but I'll show it to you later at the end if you're interested. In another work, Christopher Trebesch and others document what the so-called no Paris Club clause that's included in the debt contract, where China explicitly forbids countries from actually releasing the terms of the arrangement to other lenders, both institutional and others. But to be clear, today I was going to move to the slide, to the model slide. Today I'm going to take a very stylized version of what it means that it's unknown. I'm just going to assume that there's something random about it. What I will not show you today is counterfactual that are leaning on or trying to tweak the information setting. I'm not going to do anything about that in progress. So today, from my perspective, I'm just going to basically say there's something stochastic from the perspective of definitely lenders and borrowers about the debt relation with China. Does that answer your question?
Yes, and then on the next slide, this data set that you leverage, it gives you a little bit more of information than, I don't know, in official data sources, or kind of you're trying to overcome this issue a little bit, or this is not what's the aim of the assemble the data set?
So the first part of the data, the Chinese funding and restructuring events, that is the extensive and detailed work that various institutions have been trying to do over the last few years. The work by Horn, Reinhardt, and Trebesch has in the recent update where they bring together essentially estimates of Chinese debt stock over time. We are using that. We are not redoing that. It's really painstaking work. It's really hard to do. And that's what we're using. What we are leveraging that for is to use variation in both the timing and size of those things to inform how market debt is affected. And so it's the second side that we bring to the table, which is, and it's tedious, but it's nothing grandiose, but it's just basically how can we basically say something about sovereign debt dynamics. And so we need yields and we need debt issuance. We need quantities and we need prices. That's it. And we're just combining it for the sake of the question we're interested in.
Okay, thanks.
Okay, all right.
Kondo, we have one more question that's okay to ask.
Okay.
So it's a clarification question from Sergio De Ferro from Economics Department.
Yeah.
And he's asking, after a China lending event, does the country borrow less from non-China lenders or from everyone, including China?
What I will mean by that is after China lending event, thank you for the question, Sergio. After China lending event, the country borrows less from other non-China lenders. And in particular, I will be able to show that they issue less on international capital. They are less likely to issue on international capital markets as well.
Thank you.
All right, thank you. All right, so using these facts, we take these facts to a model, and you might ask why a model. We're using the model because we want to both understand sort of the macroeconomic factors that could be driving sort of the facts we're uncovering, but also being able to do counterfactors. So what we do is we take a state-of-the-art sovereign default model, long-term debt, and we aim to rationalize these facts so we can basically counterfactors. The key tweak, and it's a very simple tweak, that we make is that we augment the model with essentially China rollover risk. The idea is you can borrow from China, but you may not be able to roll over. One day when come where you have to pay, and that doesn't go well, you have to restructure the debt, and restructuring the debt interacts with your international capital markets, just the same way when you're getting the inflow from China, that may have eased the pressure on international capital markets. That's a stylized model. What we are stepping away from is we are not modeling the Chinese Chinese lenders' behavior. We don't have a sophisticated model of the pricing of that. We're just going to take that as literally an exogenous process, but that will endogenously affect default risk in our model. So there will be endogenous default risk on marketable debt arising from these non-marketable debts that relation with China. What I will show you today is that this model, although very simple and highly stylized, can actually rationalize qualitatively and to a certain extent quantitatively the stylized fact I'm going to show you. We will find that in this setup, and I will explain to you why later, we're from China on net has positive welfare effect, but the effect this positive welfare effect dwindles very quickly as the country is more engaged into international capital market borrowing. As I mentioned earlier, I'm not going to do any counterfactuals about information frictions and transparency counterfactuals today, but that's definitely on our mind. So let me sort of give you an upshot about what the model will do before we go to the data, and then before we go to the data. So if you want to think about how through the lens of the model, I want you sort of we're thinking about the Chinese debt events is that we're modeling China. We're assuming first that China is modeled as non-defaultable debt with rollover risk. What does that mean, non-defaultable? Precisely because of these no Paris Club clauses, these resource-backed loans, and even the fact that as recently as this past year when Zambia defaulted on its Eurobond, it seemed as if it was not a conversation about defaulting on the Chinese commitment. We are going to take that as motivation for this assumption that we make in the model. Now, what does that assumption buy us? It buys that when you have a restructuring with China, in the model, that's akin to a sudden stop. You suddenly have to pay back China a lot, or you have to, or a negative output shock in our setup. Those are two ways to think about it in the model. Mechanically, what it tends to do is it puts pressure on the market, on the borrowing international market, leading to a slightly higher default risk, which then can rationalize the higher yield I am explaining. On the flip side, when there is an inflow of Chinese debt, lending from China, it actually leads the country to delever on the international, from market debt and enjoy lower yield. It's a very, very simple way to sort of think about the key model mechanisms. I can circle back to them in detail, but that's sort of the upshot of how the model is going to work. This interaction between is what seems to us that, or at least what the model will lead to rationalize the fact, which is it's harder to default on the Chinese debt, and then how it's feeding back into how the countries have to borrow more, change their borrowing on international debt markets.
Sorry, Kondo, we have one clarification question, which you might have answered just now. Why do you focus on long-term debt?
The long-term debt is going to be, the short answer is that with long-term debt, we get more, the long-term nature of the debt gives us an amplification mechanism for how the debt restructuring and Chinese inflow affect the price. Intuitively, this is what it means. If a country is borrowing $1 or borrows $1 today on international capital market, or a euro, or a pound, the intuition is that when it's long-term, there are what's called debt dilution concern. The idea will be that the lender is concerned that the fraction of that debt that will still be around, let's say, in 5 years, is subject to the risk arising from the country maybe needing to borrow more in 5 years, precisely because it's in trouble with China. So long-term debt allows us to have that feedback in the price of the debt today and in the price of the debt. So that's really the main reason why we do that. And we think that's the right way to, that's not the right way, but that's a good way to think about these Chinese debt relations, because we want to think about what happens when you don't really know when the Chinese sort of helicopter drops will stop, when the Chinese largesse will basically come to an end. And so long-term debt is good for that. Anyway, we can circle back to that, but the upshot of it is that the dilution concerns that come from the uncertainty about the rollover risk timing.
Thank you. And we have one more question. Are you okay to take it right now? It's from Chris Woodruff.
Yeah, thanks. So I guess I'm just a clarification here, whether I think of the debt restructuring itself as the problem, or the conditions that necessitate the debt restructuring that's causing all this. So debt restructuring doesn't happen exogenously. I guess it happens when countries get into a certain trouble, right? So is it the process that the Chinese are just different than the IMF, or is it just that when countries get in trouble that?
No, you're right. And so I hear a question in two ways. It's like causality and reverse causality, or sort of macro endogeneity side to it. I'm going to take a very simple take on it. In the model, debt restructuring would just basically mean when China says you have to pay me more than the break I've been giving you. And to answer your question, what that means is that we are assuming that China basically gets what it wants. That goes back to the first bullet point I put up there, which is we are starting with this assumption that the Chinese debt relations are different. We're going to take an extreme stance on it, which is that when they say pay us, you pay them and you tend to walk away. Another way to think about the exercise, Chris, will be that if we didn't do that, it will actually be harder to rationalize the facts. So if we had to relax those assumptions in some sort of more continuous and smooth way, I would suspect that the more room we give for the countries to walk away and do things that are akin to what they will do to the international debt capital markets, the harder it may be to basically get the fact. But the short answer is, for us, we don't have I don't have an endogenous debt restructuring process. What I really mechanically mean is that debt restructuring in the model for us will basically be a rollover, a sudden stop from China that basically is requiring the country to basically pay back more.
But I guess what you said about China, I would have thought that you would apply to the IMF as well. So again, maybe the question here is, what's the counterfactual? Is it the IMF, or is it private banks? Yeah, where that can walk away from private banks and I can get away with it. But
that's a really good question. For us, the counterfactual. For us, we're thinking about everything I'm saying could potentially apply to the Paris Club. And I will show you at the end in 3-4 slides that the reaction to Chinese debt restructuring we are picking up is actually not quantitatively and qualitatively different from how markets in the past have reacted to Paris Club restructuring. So from the perspective of the market, non-marketable debt from Paris Club or non-marketable debt from China, when it's restructuring news around, it seems to be moving markets the same way. So if I were to split the country debt in 3 bins, markets debt Paris Club bin, and China bin, I'm interested in how the non-market bin is affecting the pricing of the market. The Chinese one is giving some interesting variations, and we think that it may be different in some ways. But the counterfactual really seems to be market versus non-market, to the extent that the Paris Club is different from China. That matters. When you start looking at the details, some may argue that the way France is dealing with Delta Ivory Coast is not different from the way China is dealing with Sierra Leone. Who knows? But yeah. All right, thanks. I really like those questions. So, all right, so let me get into the data a little bit, and I'll circle back to the model later. So as I said, the data is pretty simple. And I know I hear you used to sort of more detailed data, but this is what we have. It's annual country level data. In a previous version of this work we did, we had some monthly stuff, but it was hard to pin down events and get highlight. So it's annual data, 2000, 2017, because that's the horizon around where we have better Chinese debt restructuring data. And as you saw on the initial slide, so I'm a trade economist as well. We talk about China shock a lot in trade. Well, the big China shock in international debt markets is basically sort of in these 2 decades as well. So it's the right time to capture it. We combine external debt statistics from the World Bank standard data set with Chinese debt restructuring events. From the latest update from Hornreiter and Trebesh, what's good about their latest update is they basically incorporate a lot of work that other institutions have done about sort of size, carry, aid data, and others have done to basically track down these Chinese debt stocks. And then, as I mentioned, what we do is that we go in Bloomberg, we basically pull essentially all the bonds we can pull from these countries, and we re-aggregate them back to basically construct measures of long-term debt bond issuance and yield. This data is not going to be balanced, and for a simple reason. Most countries are not issuing on international capital markets. In fact, that's a story for another day, but you can see that there's a clear negative correlation between borrowing on international capital markets and borrowing from China. The more countries are in international capital markets, the less they borrow like intensively from China. So what happens, so part of the data is not really very balanced because the few bonds that some of these emerging developing nations issue are not consistently tracked in Bloomberg, Alba Bloomberg. But I believe we have the best we can do in Bloomberg. We may be able to use data stream, but for now, that's what we have. And I'll show you how that affects the results later. So we have a very simple benchmark. And I'm not going to push too hard on, we have a very simple benchmark, and the way we're going to basically think about how China debt events. So this can typically be either a new funding or a restructuring event. And we're going to basically look at how it correlates with a set of marketable debt outcomes, such as issuance, yield, and also using the World Bank data, we're going to look at external debt to bondholders as reported by the World Bank. While restructuring events may be relatively clear to define in the data because it's already a sort of coded as an indicator variable, the funding variable is not as trivial. So what we will do is that we've noted in the data, many countries are constantly getting some baseline inflow from China. It's not as zero and then something comes in and it goes back to zero. So in everything I'm going to show you today, I'm just going to define a Chinese funding event as a period for a country as a period where the inflow from China is large, that is above the median change in the cross-section of all countries and periods. That's the simple definition I'm going to use. In all the regressions I'm going to show, I'm going to have time fixed effect, country fixed effect. I'm going to control for relatively standard macroeconomic factors such as GDP growth, foreign reserves. And when I'm doing regressions on prices, I will also control for measures of how of the level of the debt of those countries. And so this is the simple benchmark I'm going to use to document the fact. So this is our first fact about Chinese lending and deleveraging. And the fact is pretty simple. So let me focus first on this number. And this is what I mean by Chinese funding events, all else equal, is associated with lower external debt held by bondholders. So what does this mean? This is the stock of, this is log external debt as reported by the World Bank. This is not all the external debt. This is just the portion that's held by bondholders. So this is us trying to hone in on a World Bank measure that's close to the market as opposed to other types of external debt the country may have. The size, the magnitude is large. This suggests that the point estimate across the specification is between sort of 13 and 20%. In the first specification, this is just basically just doing it on levels and using all the countries that we have debt information for. In the background, as I mentioned, we have country fixed effect, time fixed effect, all the regression in level control for the lag of the external debt. The second specification here is to us we like it a lot, because what we do in the second specification is that some countries are serial China borrowers. If you take a country like, let's say, Angola, you can just see that constantly they're getting streams of funding from China. So what we do is we try to do an exercise where we say we exclude both the first event, which is the first China event, and we also try to exclude countries that basically have countries like Angola where they have a lot of China events back to back. So we don't really get a change between sort of a pre versus post or a non-China pre versus a non-China. So when we exclude the first China event, simply because we want to avoid potentially identify as scams from the first time Chinese funding, and identify through sort of successive funding events for other countries, the point estimates are a little lower, suggesting that the funding event delivering effect is probably bigger for the countries that had either fewer China funding events or the first one only, but we still get a significant coefficient. And then in specification number 3, what we do here is that we do it in change. The numbers are similar. And then in the last specification here, the coefficient is not significant, it's negative. What we do here is say, well, if one were just to ask sort of a pre-post-China world, so we are coding this China funding error that's just identified off of the first China funding event of a country. So after the first China funding, we're gonna call China funding error is equal to 1. Are your yield, are your borrowing spread higher or lower? And we don't have, it's not significant. And maybe this is consistent with what I will show you later about the rising yields. But the upshot of this slide is just to say that external debt is lower, the debt owed by those countries to bondholders, not the Paris Club, the bondholders. In fact, if you do it with the Paris Club, it doesn't seem to be moving, to be affected. So while that measure was using the World Bank overall sort of report, we wanted to really hone in a little more on activity on the international capital market. So using this bond level data, we can construct bond issuance variables, which is we can say whether or not a country issued a new bond, a new long-term bond in a given year. So when we use that variable, we basically get a similar. So think of it as a linear probability model. That's simply what it is. The underlying sample is changing again because now not all the countries have not all countries have issued a bond at some point. But what we see here is that we basically get a similar decline, meaning that in this linear probability setup, a China funding event is associated with a decline in the probability of issuing a new bond in international capital market of about 10 to 20%, depending on the specification. And as you can see here, we get a margin significant on this sort of pre-post China funding era. Again, I think the specification number 3 is my preferred one. It's a change on the funding event, and it gives us about sort of 17% here. So those first 2 facts are what I think are sort of the evidence we have on quantities, if you want, or debt dynamics in China funding. And market debt dynamics. This is not about potential strategic behavior that could be happening later on the Paris Club side or others. This is just on the market. And then we turn to prices. And so we replicate a similar regression, and where now we also control for the level for the debt these countries have. And now we're looking at long-term debt. And Well, what I want you to see is that these numbers are big. I mean, what this tells us is that all else equal, a China funding event is associated with almost 85 basis points lower yields. That's sizable. You know, depending on the country, these yields are anywhere between 6 to 8%. When Venezuela in trouble, that makes it 15%. But 85 basis points is big. Again, if you specification number 3 in change is yes, Chris.
Just to clarify, this is the interest rate on the non-Chinese debt.
This is the interest rate on not just the non-Chinese debt, is the non-Chinese is market bonds. So this does not even include debts to you know, the developing agency in Germany or in France.
Okay.
Or the African Development Bank.
This isn't mechanical that the Chinese are given subsidized loans, and so that's lowering the overall cost of capital, because it's lowering presumably if they're giving low interest, then the whole effect on the country is even bigger than that. That I'm getting an even lower interest rate because of the Chinese debt itself.
Yeah, absolutely. For me, if I was sitting on the Minister of Finance for one of those countries and I had to impute sort of my interest pay, my debt servicing, my debt servicing or my interest payment, it will be lower probably because one, the China being is probably subsidized, although depending on how you do it, it doesn't always seem to be the case, but partly because you have lower potential subsidies on the China funding side, but also potentially in terms of how the Paris Club side is interest rate is changing. I don't have any result on that, but this is just suggesting that if this country were to borrow, they will basically be facing lower yields. Now, the way this is showing up, however, is that remember in the data, these countries, Chris, they don't go to international capital markets often. So one can also see this as because this is long-term debt, and this goes back to the question on long-term debt earlier, one can also just think of it as precisely because it's long-term debt, you have to reprice the outstanding debt, knowing now that these countries have a certain position with China, right? That's my preferred interpretation. In the model, we're not going to be able to distinguish those two, but that's that's the way I think about it. Okay. And now we turn to, well, so far, maybe like China is maybe a good thing. You get, you get some money, you don't borrow so much from international capital markets, and the yields, the spread seems to be lower. Well, not so fast. Chinese debt restructurings can be costly. And what I show you here is that, first, before showing this, I have a caveat. Debt restructuring, just like defaults, are rare events. So what my sample size is going to collapse. So I'll show you, even though it wasn't balanced before for a variety of reasons, now I'm basically, it's going to be cut in half, partly because we just don't see a lot of restructuring events. That's the first thing I want to report. And the second thing is that when I want to do control for some controls, I got mixed up in 3 points I wanted to. The first point is that I don't see a lot of restructuring events. So all the point estimates I'm going to show you, take with a grain of salt. In fact, I can tell you that Venezuela is the only country for which is consistently sovereign bond yields, and that have had a few debt restructuring and is super well identified. And Venezuela is driving this point estimate. But I cannot drop Venezuela because it's not as if when I see Ghana and Nigeria restructuring, I don't see enough data around them. So part of this is, even though these things are significant, we have to be careful because you don't see a lot of events. That's the first point, the first caveat I want to make before I tell you what the results are. The second caveat is that because the bond yield data can be sporadic for some countries, when it comes to this regression, there's some specification that I just don't do, on which I don't do so well, because when I do more control for lags, I don't have enough data. Those are two caveats. Conceptually, it doesn't change anything. This is really the reason why I'm showing you this. Now, what's the result? And what's the result I have? The result is that a China restructuring event is associated with a large increase in sovereign yield. If 85 basis points were big in terms of the decline for funding, a restructuring event seems to be associated with 300 basis points. Now, you'll say, well, that seems large. And this goes back to Chris's earlier question. I said, well, I happen to have data on non-China restructuring events with the Paris Club and others. How did they move marketable debt prices? Well, it's not that different. About 300 basis points as well. I cannot reject that they're different, in fact. And in fact, if I run only one, so the first three columns for me, I just gonna say these restructurings are costly. China, if at the very least, Chinese debt restructuring seems to be as costly, but as other debt restructurings. That's what I can say. In column 4, 5, and 6, I try a version where this is the lagged. The reason I don't do a control for the previous one, when I do that, I lose more countries. Things are still significant, but they're more, the sample size is too small. There's a version where I only restrict to countries that ever had a restructuring. The results are qualitatively similar. There's a version where we had monthly data in an early version of this work where you see the spread on a different set of countries. We basically had increases in yields, but not nearly as large, things that are closer to 50 to 100 basis points. So, but the upshot here, if I want to take a step back away from sort of these data and sample size issues, is that we do find that Chinese debt restructuring are associated with increases in sovereign bond yields, and they seem to be pretty large. That is sort of the third fact that I wanted to document about China. I cannot reject that it's China specific on this side. I will do more work on that, but that's what we have. So to take stock, so what I want to sort of to take away from these slides is that using this data that we put together, we document three main facts, right? That borrowing from private lenders is lower following China lending events. That yields are lower as these countries borrow less from private lenders. But also that debt that those countries take on and that seem to have this potentially good effect in terms of potentially good effect also come with a potentially very high premium when that debt goes through a restructuring.
I'm sorry, Kondo, I just want to give you a heads up. You have about 10 minutes left.
Oh, thank you very much, Margarita. I think that's about the right time for me. So now we could just stop there and go home, but I went to Minnesota, so I need to put a model on this and think about it. But more seriously, we want to use the model to start thinking about what it takes for the model to rationalize those facts so that we can also do counterfactuals. Today, I'm not going to do too much on the counterfactual side, but the real reason why I'm putting a model to make sense of these facts is because I want to think of alternative policies. In particular, I'm going back to the motivation, potentially, not just whether or not these relationships are good for welfare, but other arrangements that can improve the welfare of the borrowing countries. All right. So this is going to be a very standard sovereign default model. The only twist is that we're going to add stochastic China debt fluctuations. So a standard sovereign default model tends to be a small open economy where you have an endowment. So these are not typically production economies in the baseline setup. What we're adding to this endowment process of these countries is that we're going to have this random process of the debts vis-a-vis China. It can be low or it can be high. And it can transition from low to high. So when you transition from low to high, that just means that China, there's a helicopter drop from China, a lot of money coming in. And when you transition from high to low, that's what we're going to call, you have to pay up, it's a restructuring. So they will be showing up essentially as additional shocks to the endowment process, but these shocks are on net, basically, they're going to affect the consumption path of the country. And then in addition to that, there's market debt B. This is going to be endogenous, right? This is going to be endogenous. It's going to be long-term, we discussed that earlier, and it's going to be subject to default. And this obviously is also endogenous. Right, simple setup. The only trick is this China debt, this China shock that we're adding to it. Let's see. Just a quick notation. What it means, what I really mean is that the net flow is going to depend on this switching variable A. So when A is 0, that means that I'm low. I have low debt, I stay at low debt. When A is equal to 1, that means I'm going from high to low to high. So I'm going to be using this variable Z and this variable A. It's a little bit of a notation, but just to clarify, so the Chinese debt fluctuations. So this is the government problem. It's a relatively standard problem, and I'll highlight the few things that I want you to pay attention to. In this class of problem, the government takes as given a price function, which is how much lenders will charge a country who borrows a given amount. And then it makes it to a couple of decisions. First, it decides whether or not to repay. There's a D decision. And then when it repays, it understands the value function it faces. So when the country chooses to repay its debt to international capital market, given knowing the outstanding debt B, the debt it faces, it has with China, and whether or not it has to repay China or not, then on the repayment, it's just you have the flow utility and then the continuation that takes into account whether or not the default. Let's look at the borrowing constraint, the budget constraint of the government. It has a couple of things. The first subject is that you're consuming out of your endowment. You're borrowing from international capital markets by choosing a new decision B prime, a new debt level B prime. So in this model, this is the standard channel. You're borrowing from international capital market to smooth your consumption with the option of default. What we're adding is that we are adding these China shocks, which depend on these high-low switches that the countries may face. Obviously, this will feed back into the debt price that I'll show in a slide. And then there is also the value of defaulting, which is if I default, in the standard, if I default, I have to have I have a default cost fee, which is standard in the literature. Notice that the assumption about not defaulting on China means that even when I default, I still have to honor my net outflow position Z vis-a-vis China. This is the extreme stance we're taking on China in this version of the model. The price of the bond price it follows a standard formula in the sense that this is the discount factor of the lenders. This is the repayment probability. So if this were long-term debt, this would just be the repayment probability. It is a short-term debt, excuse me. This would just be Q is equal the probability that you repay discounted. But because this is long-term debt, it's not just the fact that you repay. You also know that each unit of debt that the lender is lending to the country not only can be repaid with, let's say, probability expectation 1 minus D, but there's a fraction 1 minus D that hasn't matured, and that fraction has to be priced again. So this is the outstanding debt price, which then has to depend on the continuation policies of the government. And this is where obviously the rollover risk that's embedded in this BC object is showing up, and also indirectly in terms of how it's affecting the borrowing, the B prime that the country is doing on international capital markets. So I'm gonna skip the equilibrium slide and just jump to what I do in terms of a couple of exercises. So we're gonna basically put some numbers on this here. We're gonna put CRO preferences, a standard AR1 process, a standard quadratic default cost. And then I'm gonna focus on the bottom of this for a second. I'm just gonna assume that this high-low is like essentially when China can give you up to close to 10% of your GDP in terms of funding. So that's on the high end of the numbers I showed you. And then you basically don't pay China for a while. And then occasionally China says, hey, you have to pay me back. So this is the HL switch I'm going to have. How persistent is that? It's an IID shock where you typically stay, the switch is very rare. So it's not often that you have to basically face this rollover risk. But that's how, this is sort of this bottom block is sort of this rollover risk block that we are adding. We have sort of, I would say, carefully chosen the other numbers. We have some calibration work on that way, but I wasn't ready to finish that for today. So this is a parameterization and calibration. The results are similar when I do a calibration exercise, but they're not quite ready. So what do I have? First set of results. The model is actually consistent with the empirical findings along a few dimensions. First, let's look at marketable debt. So unconditionally, so this is the debt when I'm sorry. So this is the I highlighted the wrong row. I was going too fast. Let's look at market issuance to GDP. So what the model is giving you is that when you have a China inflow, you deliver from market. You don't issue you don't have new issuances, And when you have to pay, when you have the China restructuring shock, you increase, you issue more. What that maps into is that you have this, we get this result on spread, which is spreads are lower. So the delta between this and this is about 40, 50 basis points. So spread at 50 basis points when you have a China funding. So maybe about half of what I find in the data, and about 150, 60 basis points higher when you have a China restructuring. So this is sort of the facts 2 and 3. Where does that come from? The countries become more likely to default when they have restructuring events with China, for a lot of things. Partly because they borrow a little more, partly because the output from China is akin to a negative output shock, and a few other things I will discuss soon. I don't have a lot of time, but let me show this. Margareta, how much time do you have?
You can take 2 or 3 minutes if that's okay.
Okay, so in that case, I'll skip this slide, which was about how the country reacts to the funding shocks, and I'll go to 2 counterfactuals, which is, suppose I take this economy and say, no, let's ban borrowing from China. How would you fare? Well, no, the spreads will actually be a little higher, and default frequency is slightly higher. And essentially what this is picking up is the fact that on net, China is giving you, the way we've modeled, because it's subsidized loans, you have a little more, and on top of that, you have the fluctuations. And as it is, the model will tend to basically say, hey, these numbers are all positive, so this is positive numbers. That you have gains from, the welfare numbers are positive when you borrow from China. So on the x-axis here, I basically have output. And what I want you to see is that when you look at this line, the solid line is just telling us that you have positive gains, but they decline the borrowing economy. So suggesting that there's a potentially room for this debt relation with China in states where the economy is really is not. Actually, let me take it back. I was going too fast and I said the opposite. What this tells us is actually that it's an economy that's not in good state, right? Output is low, that gains more from this debt relation with China. And why? Because when you have a bad economy, market prices are really high. So having the option to borrow from China, even in this random setting, is actually good. What I wanted to show was that when the debt is higher, so this is the dashed line, when you have more debt on the market, those gains dwindle a little bit. So the gains are not as high when you have debt on the market. I can circle back to the mechanism behind, which I skipped, but I would like to conclude and say, in this relatively preliminary work, what we do is that we document significant effect of Chinese debt event of both sovereign debt prices and its dynamics. We use a really standard benchmark model to rationalize these facts. We plan to explore more information friction counterfactuals, given the concerns around the opacity of Chinese lending terms. And thank you for all the questions, and I look forward to your additional feedback.
Thank you so much, Kondo. So now, if you have any question at all, can you please raise your hand, and we will unmute you so you can ask your question directly. So I'm going to start with Chris.
Okay, I'll jump in while everybody else is thinking I've hogged all the time. But so I guess I wonder, can you tell us anything about so the levels, the effects aren't so different if I look at Paris Club or China, but I guess I'm wondering. It's sort of a two-part question in a way, or two. One is, do I think of China as just being reactive here, or do I think of them as being strategic in a sense that I'm kind of lulling countries into something and then I'm jumping in and kind of, sucking out surplus at some point? And I guess in that regard, do I think of them as behaving differently than other, Paris Club type lenders? If I think about not the effects of what they've done, but the process, that when they jump in, the kinds of things they demand when they jump in and so forth, are they behaving differently than other lenders?
First, we know China is behaving a little differently. on the observable part of the contracts. Now, that doesn't mean that some Paris Club countries on some non-observable part of their own contract are doing other things. But so there have been some concerns about sort of mainly the transparency, especially during with sort of the pandemic related debt relief that countries wanted to have. There were in fact, Zambia, as it defaulted, had to restructure, and they're still concerned about their ability to combine and incorporate more about what is known about its debt with China. So China seems to be different. If I had a model of debt restructuring, that would be certainly a place where the interaction would even be richer. We're not doing that. Ashtik, our co-author, our junior co-author on the paper, in her thesis, one of the chapters in her thesis is actually trying to take more seriously that strategic side into account, and those artifacts such as the resource-backed loans and others. I'm not aware of a large literature on this interaction between market and non-market debts anyway. So to the extent that, so I will expect that ultimately there could be heterogeneity in the effect of non-marketable debt on marketable debt. What governs that heterogeneity to be seen. What our model is suggesting is that the inability to default on China matters a lot for how the market is pricing this. I mean, I didn't do it explicitly when I did the China borrowing, but I could have done a version where when they default, or they can basically, they can basically say, no, we're not paying China back. That's what the model is hinting at in terms of how the market prices are affected by these debt relations.
Great. I have a question from Julian.
Great. That was super interesting, especially for even for somebody like me who doesn't understand a damn thing about macroeconomics. So thank you. I just have one question. So you talk about how opaque those contract is, and kind of how China is kind of this new kid on the block in a sense. And I was wondering, do you see the same effect at the and you have quite a few years in your sample. So do you see the same effect at the beginning? Maybe the market is still kind of trying to learn what China is doing versus what's happening now, and there's a kind of a dead event where kind of maybe lenders have a bit more of a sense of what type of strings are coming attached with those Chinese bonds and Chinese debt anyway. So I just see, maybe you can do it, you don't have enough data, but it'd be interesting to see if there's some kind of the effect of time on that.
Yeah, well, first, thank you for going through, stay with me through a macro talk. I'm not sure if I will be able to do that exercise. I've thought about it, but even the data we have right now is exposed data on the debt stocks. So to be clear, what I'm doing is I'm sort of suggesting, it's not clear to me that the market knew that the China funding event I'm identifying exposed was news to the market at that time. So that's how opaque this is, because it's really hard to pin down. What I have been interested in is, and I probably won't do it, but there's a world where one takes, like, you go into, let's say, the Bloomberg or something, and you really do a news search, and you really try to track new, like, real-time news associated with China, and then you see how the effect is changing. I think that the one thing that is clear in the data is that if I show you this, the first result, when I look at column 1 and 2, I'm excluding the first China funding of any individual country. They tend to be early, in the early part of the 2000s. The effect is smaller. So it might be that if you were to force me to read too much into it, which you're not asking, but I will, it could be that in the early part of the early 2000s, people saw China as, oh, it's just an extra source of funding. It can only be a good thing. If anything, you'll pay us out of it. And then later on, maybe it's understood that it's not as generous, and therefore the countries both deliver less when they go in the market, and the effect on yields, which you don't quite pick it up here, but maybe if you read hard into especially number 5, which is doing the change or the 2. I don't want to push too hard, Julien, but it's interesting. I'm worried. The noisiness of the data and the exposed collection makes me a little worried about it. It's interesting. Yeah.
Thanks.
Thanks. We have a question from Jean from Economic Department.
So thank you very much for a very interesting presentation. So I do have a question about the accessibility of this China funding. So is there actually like a reason? I think there is actually a reason that, you know, the countries are actually just borrowing money from China instead of actually from market. So if it is the case, and then is it actually possible for you to actually incorporate this in your macro model, like in your constraint? So actually it's kind of more easier to actually borrow from China under certain circumstances. So they do actually have a reason to actually borrow, to choose China over the other.
Yeah, that would be a model where the BC that I'm putting in is endogenous. The challenge with that is that there are two ways of doing it. First of all, that goes back to Ashtik. She's trying to do something like that in her papers. But let me show you one slide where I think I can constructively answer your question. So what it means is that on this slide, the B is the endogenous state, is the debt to the market, and the BC is the debt to China, which is exogenous. Now, what we're doing in this setup is that the country still wants to smooth consumption, knowing that it has a random stream of endowment Y. BC, over and above the fact that it's subsidized, it also has a risk underneath it. So what we are taking on right now is the rollover risk aspect of it. Now, I've done work on rollover risk and CSAE as well. That's something we can take on, but what we're focusing on is the fact that the rollover risk, even an exogenous form of rollover risk alone, seems to go some ways in helping us make sense of qualitatively of the fact. The challenge people have, I think one of the key challenges in endogenous in BC is not the fact that you have a portfolio choice. I really think that it's the fact that the pricing, the Q, is a little harder to discipline, right? Here we're having sort of a very clear Euler condition that disciplines the pricing of the debt. The Q for China is a little more complicated. It's geopolitical, strategic. You say subsidized, but maybe the volatility that we're picking, going back to Chris's questions about, you know, do you strategically ask a country to pay back when it's really in macroeconomic trouble so that you can seize a port? I don't know. But so the challenge in going in that direction is not really having a portfolio choice. It's not even having the volatility and rollover risk. It's really having a theory of what the Chinese Q, so this, I'm going to highlight it again. A theory of this is a little trickier to sort of discipline with the data. Ashtik is making progress on that, but it's interesting. I don't know what that is. So we went not the easy route, but we went in a way that isolates on the rollover risk component. As I mentioned, many of these countries are not even borrowing from the international capital market as they're borrowing more and more from China. So that's a relevant, extensive margin to think about. We are not touching that though. Yeah.
Thank you.
Thank you so much, Kondo. So we are actually out of time. It's perfect timing. Thank you so much for your talk, and it's been great to hear you speak. I just want to mention that our next webinar will be on Wednesday, Wednesday, June 9th, from 1 to 2 p.m. Chris Woodruff is going to be presenting the long-run effects of cash grants, the Sri Lanka microenterprise project after 10 years. We hope to see many of you there. And thank you so much, everyone. And thanks so much, Kondo, for your talk.